Welcome to Lock in Your Success. We are the company that creates strategies to build wealth. This webinar reviews real-time hypothetical trades each week while analyzing market conditions with adjustments. Questions are always welcomed, asked, and answered. Before we get started, we need to go over our disclosures. Locking Your Success LLC is not a broker-dealer or financial advisor. This presentation is for educational purposes only. This information is not an offer to buy, sell, or hold securities. You shall be fully responsible for any investment decision you make, and such decisions will be based solely on your evaluation of your financial circumstances, investment objectives, risk tolerance, and liquidity needs. Please visit cboe.com to find and review the options risk disclaimer prior to placing any trades. Also, please note that these are real-time but hypothetical computer-simulated trades and results. The trades are believed to be as accurately presented as possible, however, they are not guaranteed as to accuracy and therefore live results may vary. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Whew! Now that that's over, let's get to it. Here is your host, John Locke.
Good morning, everybody. Welcome to the Options Trading for Income Weekly Update for October 19th, 2015. I would like you guys to forgive my confusion and choppiness this morning. I had an update I did to my computer last night, which consequently shut down my system, and I was up till probably 1 o'clock in the morning last night just getting the system back up and going, and didn't have much time to prepare for this morning. So we will do the best we can as we move along here. So anyway, if you're watching this on YouTube or you're listening via podcast, come over to our website, check out our programs, and join our mailing list to get your free report, 7 Secrets to Becoming a Successful Trader. And of course, you can sign up for this free weekly webinar. And as far as our trading programs, we have the super simple spread trades program. We have the M3, the bearish butterfly, we have the Rock, the M21, and of course, we have APM squared. In this update, we are going to cover some of the trades from the various programs that we have. One of them is going to be a bearish butterfly. We're also going to cover an M3, a Rock, and a V Condor, which is in the SSS trading system. These are real-time computer simulated trades. And of course, if you've been with me for a while, you know we've been doing this in one form or another since about 2010. And we do it month after month. So everything's going there. As far as announcements, this month is Oktoberfest. We are, or SMB is actually holding special sales on some of the programs, as well, especially the Rock program. And we're going to be doing a webinar on, I believe, Wednesday, October 21st at 4:30 p.m. Eastern Daytime. Also, some other things that we have going on. Let me drag this up here. For our community, again, this is a work in progress, and we are currently getting feedback and getting suggestions from members, and we're doing everything we can to make this as good of an experience as possible for everybody. So keep in mind that we will be changing things, moving things around, and things like that, just to get that going. This month we are having our Successful Options Trader of the Month monthly webinars, which is going to be a members-only access thing, at least to the live webinar part of it. There is going to be a web registration link here. It's going to be October 27th, 9 a.m. Eastern Daytime. That's going to be a Tuesday, and we're going to do an interview with Jaroslav, who was our Successful Options Trader this month, where we'll go over, we'll see what he did, and why he was worthy of such an award. Also coming in November, starting next month, is we're going to be doing, for our members, we're going to be doing a monthly webinar, and it's going to be on various topics. It might be on one program or another program, or trading psychology, or a whole bunch of different things. This first one is going to be what I call Trading Lab. It's something that I've done with some other people before, particularly some of my one-on-one clients, but essentially the idea behind it is, we discuss relevant subjects with the marketplace. You're going to get to take a look at some of the adjustments and strategies that I'm playing with, as well as new trades that we're developing and working on and coming out with. And you get to be a part of that, see what's going on, maybe have your input, and you can apply some of these new strategies or what we've been doing that actually hasn't been out to the general public yet, and you can apply that to your own trading. So that's going to be a lot of fun with next month with that. And also, we're going to maybe shifting around who has content to, who has access to what and stuff like that. And we're going to be doing something with the options trading for income webinars here. They're probably going to be behind some sort of a membership wall to attend live. That doesn't necessarily mean they're going to be charged for, but at least get it behind a membership wall. Like I said, we're just shifting around some stuff. We want to give you as good a value as possible, be able to get certain things out to more people and stuff like that. So again, if you have any feedback with our community for you guys who are in there, that's great. And remember, we're just starting out here. We're going to be adding a lot of content to this every week, and it's just going to get better and better. So it's going to be a lot of fun. All right, so moving forward here, let's take a look at what we have going on in the markets and go from there. So one of the things we've been doing is we've been calling the markets extremely well. Let's just take a look at the Russell here. Last week, I was expecting a retracement off of this trend line here, coming down and expiring in the red circle. Not bad. Thursday, we had a pullback off the trend line, which is expected. I figured it would be to 1140. It went just slightly deeper than that. And then, the markets have been a little bit more volatile than I thought, and it shot up a little bit over our close area. But that said, we've been saying for about 3 or 4 weeks now that this is where the market's going to expire. Now, this is pretty good if you're one of those guys doing one of the M21 trades. I mean, if you can do that, if you can set up an M21 trade and you can call expiration like this, particularly in a high volatility market, I mean, cha-ching, it's like really, really nice trade coming up. So, and I know there were several clients who did that, or several students who did that, and congratulations on an awesome, awesome trade. So that worked out really well for you guys. So we've been calling it fairly well. From here, it gets a little bit more challenging. What we got is we have some short-term bullish patterns in the market, very, very bullish patterns in the market short-term. However, we are in our shorter-term or more intermediate-term downtrend. We are at significant resistance levels, but we're not completely or fully or deeply into those levels. So, in other words, if you look at let's see if we can go to the SPX here. I may not have it up because I just got my computer going. But if we run into the SPX, we had a resistance level here, but our more significant resistance level is up here. So we're not deep enough into the resistance level where you could say it's very likely to come down. If you look at the Dow, we get the same thing. We've pushed into this resistance level, but we haven't topped to the top part of the resistance level yet. And the NASDAQ is kind of the same thing. We have a resistance level that's going to be, we're pulling into now, that's kind of deep. In other words, they're all dirty levels. We don't have solid straight line resistance levels right now. Everything, because the market's been volatile, it's been overshooting these levels a little bit, and they're a little bit dirty. So I guess what I'm trying to say is we're at a point where we could roll over here and go down, which I think shorter term or for the week that we're going to do by the end of the week. However, at the same time, there's a decent possibility that we push a little bit higher before we do that. So for the week, I would say we're going to be down, albeit we may have to withstand a ride to the upside first. For longer term, coming into December, it's a very November and December. Typically, we're very bullish that time of year. It's just a bullish time of year. So sometime before the end of the year, we're probably going to have a fairly significant rally. And the Russell, that's going to put us probably close to, for the Russell, that's likely going to put us up at least to the 1210 area. Maybe higher, depending on how. I don't think it's going to be that strong, particularly this year. I think we'll be up, but I don't think we'll be up that much. Then 2016 is probably going to be a year where the markets are going to try to push to new highs and then likely turn over. We are way, way overdue for a significant market pull down, or i.e. market, I guess some people would call it a crash, or a bear market. And we know bear markets these days have been very fast. So if you look at 2008, you look at 2010, we had a 2-day bear market or a 2-week bear market. And in 2011, the markets come down very, very quickly, and then they've been recovering very quickly. So when we actually hit that point, and I think it's going to be 1350 on the Russell, I do think it is likely to happen in 2016. That's if we even get that far. We could certainly have the top here at 1280. I don't think so. I think the markets are probably going to a little bit higher. And then from there, it's going to be look out below. And that's some of the things that we'll be talking about later on within the community and in the trading lab and in the coaching sessions is how to cover your downside and deal with specific situations like a 2008 situation, because I traded the strategies through that, and I have a lot of insight on that. So wouldn't be surprised to see it happen again. So anyway, those are my thoughts on the market, both short term and longer term through the end of next year. All right, let's take a look at what we have here for questions. Good morning. With regards to the bearish butterfly, I wonder if you could help clarify something which is more important at entry. Chart patterns, price, location indicating bearish direction or volatility. For example, if price has dropped quickly into a support and looks very likely to go up, is that not also where volatility would be the highest and the price the lowest? And if the price is high outside the upper Bollinger Band and likely to go down, is that where the volatility is highest and the price most expensive? I think basically what you're asking is butterfly prices. Butterfly pricing, you can make generalities in the market. I mean, as far as the price of a 50-point wing butterfly 20 points below the market, that's something I pay a lot of attention to in general. It tells us a lot. Common wisdom or common, I guess you could call it common wisdom, but I wouldn't call it wisdom. But common opinion is that just because the volatility is higher, the price of the butterfly is lower. And just because the volatility is lower, the price of the butterfly is higher. That's not necessarily true. You can see very high-priced butterflies in very high volatility environments. We saw that at the market bottom in 2009, paying $11 or $12 at a VIX 35, right? And then on the flip side, you can also have very low volatility environment where you have a very fast-moving day and butterflies are really, really cheap. So as a general blanket statement, you could say in general that happens, which would mean maybe 60 to 70% of the time. The rest of the time, that's not necessarily true. So I wouldn't necessarily go by that. The more important factor, there's a lot of factors when determining whether you're going to go in a bearish butterfly trade or not. I mean, like I said, if you're asking when the higher probability times are of doing well, the highest probability time of doing well is when you can enter a butterfly for like $7 and the market's been up 70 or 80 points. That's very good. That said, I mean, you can almost always enter a bearish. I mean, bearish butterfly. If you're only paying $7 for a butterfly, is almost always it has so much range to the upside that it can take, that it's very rarely are you going to actually have a problem of getting max lost out in a situation like that. It would be very, very rare. It's possible, but it's rare. The flip side is if the butterflies are relatively expensive, as in like 2013 when you're paying $14 for them, in a case like that, then you really need to time the market. In other words, you only have where you pay $7 and you might be able to withstand a 120 point move against you, particularly early in the trade. If you're at paying 14, you're probably only going to withstand maybe 50, maybe 40 if you get up into the $16 range, which actually happened for a short period of time when it was just really, really obvious the market was going up in 2013. So those are just some tips on that. So hopefully that helps. Was the recent pullback enough to reset the rut counting from 1080? Yeah, so we're looking for a 30% pullback. So like in some of our technical analysis, we say resetting. So we went 90 points, so something in the 30-point range would be that. So 1170. Yeah, so technically, yes, Russell is reset. It's ready to go for its next leg up by the type of analysis I do. Whether that's going to happen or not, that's a different story, right? But but yeah, technically it has reset itself. And do I know why the premium on the call side for the SPX is so low most of the time? All right, this is SPX options questions. Let's see, and there's 3 of them. And also, how do I get out of deep out of the money put spreads on Russell SPX? It's been days I've had the order at mid-price and no fills. Well, you need to be, so as far as the premium being on the call side for the SPX being low most of the time, I mean, it's what it is. I mean, that's the way the markets are. There is a difference between trading the SPX and Russell, and there are adaptations you need to make if you switch from Russell to the SPX. You know, one of them is to deal with the way the T+0 line reacts, and yeah, you get less premium to the upside. It's just the way the market is. I'm not going to try and figure out why it's that way. I just know it is that way, and I trade around it. As far as out-of-the-money spreads, you have to understand how to price those out-of-the-money spreads. If you're looking at an option view, which I don't even have open right now, so let me open option view. But if you're looking at, I'll just talk through it. If you're looking at your out-of-the-money spreads and they're posting you time values on your mid prices that aren't right, then you know you're not going to fill at those prices, right? Or even if they're in, whether they're in the money or out of the money. If you're looking at, you know, calls, for example, and SPX is at 2,000 and you're looking at 20, 30 calls and they're posting you a $1 time premium, and the 2040s are posting you 40 cents and the 2050s are posting you $2.36, right? That's not right. Right, there's a mispricing thing going on, and we do run into that with the SPX, especially with far from the money options, where the time premium is way out of whack of where it should be, and therefore your mid prices are way out of whack from where they should be, and you're not going to fill at mid price, right? In some cases, you might feel a lot better than mid price. In some cases, you might feel a lot worse than mid price. But you need to be able to look at your options chain, look at the time premium within that chain out of the money. If you're pricing it right, it'll fill, and that's why, again, I say mid prices don't have much meaning necessarily. You have to be able to interpret them. It's kind of like if you're in an airplane and you're looking at the altimeter, right? The altimeter says you're at 20,000 feet. But so the novice is going to assume they're 20,000 feet off the ground, but that's not reality. If you go over the Rocky Mountains and you're flying at 20,000 feet, you're going to have a problem because you're going to crash into a mountain, right? So it's just a matter. So the novice who doesn't know how to read the gauge, who's not looking out the window, is going to crash and burn, right? Because they assume they're that far off the ground. Same way reading the Greeks, same way adjusting and filling. So it's just a matter of learning stuff like that. Okay, so do I think it's a little late for a November bearish butterfly? November is, I don't even know how many days from expiration November is right now, but 32, yeah. Yeah, I would avoid going in November, 32 days to expiration, unless we get a very, very large up move in the next few days. In other words, if you go into a November bearish butterfly, you are really being directional at that point. You can't withstand much against you. What percentage downside range move are you projecting for 2016? Right, this gets into projecting things. Essentially, we're looking at our support level here at 850. So that's what I said earlier. In the year, I think, or even last year, I was thinking this is very similar to 2007. And then we get a large grinding up move somewhere up into this range here, and then come down. That's if we follow the pattern of the patterns that the markets have been doing for the last 20 years. And that's what we're looking at. So whether that happens, we shall see. I thought SPX was more liquid than Russell, and mid pricing would be better. The SPX is more liquid than the Russell, and the mid-pricing is not better. The mid-pricing is actually much different, mid-pricing is actually much more variable, where you actually get filled in the SPX. The Russell's easy. It's easier to predict where you're going to fill in the Russell than the SPX. But it is more liquid, you're correct. And again, that's common wisdom saying just because something's more liquid you have tighter mid prices, which is not necessarily true. Okay, let's yeah, okay, so we talked about the markets. We'll do one more question and then we'll move on. If I enter M3 Butterfly for approximately 750 versus 1250, will you make more money with the lower entry price, or is it all relative, or it doesn't really matter? Well, what's going to happen if you have a 750 Butterfly with an M3, it's going to have a lower delta. So if you have 10 1250 Butterflies, you're going to have to actually, if you have 1250 Butterflies, you're going to buy one Russell call, and you have to put some verticals in to flatten your T+0 line to make it an M3 trade. If you pay 750 and you do 10 Butterflies, your delta is going to be much less than 100. It's actually going to be probably around 60. So you're actually going to be able to maybe do 15 or 20 Butterflies with one call. So you're going to be buying more Butterflies, which does give you more profit potential in the trade. So a lot of times if you have like a 20 to 1 or a 15 to 1 Butterfly to call ratio, you're more likely to hit 10% faster. It's usually a much friendlier trade, easier to deal with, and stuff like that. So yeah, it does matter. Where on the context, if you're doing 16 Butterflies to $16 Butterflies, you would really tend to lower your profit target there because you're just not getting any. You're paying so. In other words, the Butterflies has a maximum value of $50. That's the most it could ever be worth, is $50, right? So if you pay 25, you're paying half the value with a Butterfly. You have a very narrow tent. In other words, you don't have much range. You don't have much of a profit range, and there's not a whole lot to make there. Realistically, you're never going to get the peak of the Butterfly because they're never going to take the money out of those options unless you actually expire the trade, right? So you're only going to get in general, you're only ever going to get around 2/3 to 3/4 of the value of the Butterfly. So if you have a $50, so if you look at $50, I don't know what the 2/3 number of $50 is, but if you multiply 50 times 2/3 or 3/4, that's pretty much all you're going to get back out of that. I mean, unless you're holding that right up into expiration. And, that being the case, you have, just call it $40. So $40 is all you're really ever going to be able to trade out of a Butterfly for, which I think is kind of high. It's probably closer to 35. So if $35 is all you're going to be able to trade out of the Butterfly for, if you pay 7, you have 7 to 35 that you can make. If you pay 20, you have 20 to 35 that you can make, a lot less. And it also really narrows your range out. It gives you less price movement range. So those are all factors that you need to deal with Butterfly pricing with that. All right, so let's just move on here. I'm going to drag this up. And those are things we'll be talking about in the trading lab, right? What things are worth, how we can adjust things, and what to do with different prices coming in. So let's go to our October M3 trades here. And I'm just going to go back to Monday. And again, I usually have this set up, but due to the computer issues I had last night, I'm a little behind. Well, let's take out these weeklies because those are a pain in the neck here. Makes things hard to see from a demonstration standpoint. All right, so here we were Monday prior to adjustment. We're basically sitting here. This trade, the market's been all over the place. Every time we make a little bit, it gets taken away from us, and we had to dig ourselves out of a hole. So it's been a tough ride. Now, a lot of people did really well actually with the M3 this month, depending on their timing on entry. But the 56 data entry Butterfly just it didn't do that well. So here's the way we were standing as of Monday. Not a disaster, but again, not a tremendously profitable either. So let me just back this out. We're sitting in a position like this Monday. We're over our maximum delta here towards the end of the day. So what I did, if we move forward a half an hour, I did one 1150, 1170 vertical. I did one 1160, 1170 vertical. essentially, if I did two 1150, 1160s, that was not enough to offset our delta to a reasonable level. So if I'm to the point generally in an M3 trade, particularly in expiration week, where I cannot, where I'm not 10 points over my long strike, and therefore I don't have a reason necessarily to roll it forward, I'll start shutting down these if I can't correct the delta, which is what I did. Another thing that you might see me do sometimes is I might roll these lower ones 10 points higher or something like that to correct delta. But in this case, this is what we did. We shut this down here, went into a position like that. On Tuesday, we did nothing. On Wednesday, we were true positive delta with a pullback on Wednesday. So here towards the end of the day, again, I'm plus 50 deltas are basically what I'll withstand on an M3 trade. Being 2 days to expiration, in other words, only one more trading day left, I did drop out of the call. This is something you generally will not see me do far from expiration because it puts us vulnerable to an upside move. But it is something that I did here because essentially I'm getting out of the trade tomorrow, and if the market, I'm going to be watching it intraday. If the market takes off, I'm just going to exit the trade, right? So that being the case, go another half an hour, I did just pull this call off to flatten the position out, right? And that put us into a position that's going to look like this, which is essentially just a condor, which typically, you know, day before expiration, if you have any value in it, is usually a decent position. Of course, the following day, the market took off on us, and I did close this intraday. So I closed it, let's see, started at 1430, right? Started shutting this down. So if you go to 1400, right, here we are, about $3,000 profit here. I started shutting down these trades when we hit our delta limits, which I hit my delta limit in the next half hour. Right, so shut down 5 of those. Upper spreads here, these 1160, 1170s. Move a little bit forward to 1500, shut down 2 more of those, and obviously should have just shut them all down. I wasn't expecting actually the market to push up that fast. But anyway, close the trade out for a profit of 1682 for the month. Not a huge gain, but it was a decent gain for considering what the market's been through, and it's been pushing us all the way around. So nice ending here for an M3. Could have done better had the market stalled, but that's what we had. So that was the M3 trade. The rock trade, if we go into Monday, if you remember this position here, I was looking for essentially, let me go into the rock trade. This was an M3 like the other one, and we converted it into rock position. When we converted it into rock position, the market took off. We drew down about $3,000. Now by Monday afternoon, we're back up that $3,000. That's why you get into a more aggressive trade, you have to expect these price fluctuations. It's kind of normal. But essentially, I told you last week that being an expiration week here, considering what the market's been doing, this trade would be exited if we solidly got 10% profit and loss in the trade. And if you look here, here's what we had Monday at the end of the day, 1530. This is the position here. So essentially what just happened is I decided to hold this overnight, mainly because I was actually too busy to close it. So this was held overnight. Yeah, plus I thought this number was a little high. I didn't think it was that high. Technically from a guideline standpoint, you would be shutting down some of your delta, but again, I just ignored it for the night. But essentially this closed the following day for a little over $5,000. So if we come to the following day here around noontime, which would have been the case actually if it was adjusted or not, because we were flat most of the day on Tuesday. So here is the position as of 12 o'clock. And I just wanted to make the point that should have had an upside adjustment, or I'm sorry, a bit of a downside adjustment. But again, here, this was perfectly fine. And this was just closed out on Tuesday for a number here that was, let me just go to the end of the day, right around, I think, $5,000 or $6,000 if I remember right. Well, let me show the T-log here. This is the T-log for our rock trade here. And our reports put us at about 55.31. So between $5,000 and $6,000. Nice trade here for the rock trade. It really recovered right at the end. So that happens a lot with this particular trade. So that was the rock trade. Let me look here. Yes, a question on for the October M3 trade. Were there a lot more adjustments needed than usual? Yes, there was a lot more adjustments than usual on the October trade. Actually, I think I talked about this earlier as well. On the October M3 trade, I wouldn't have been in that trade that long. I essentially have this thing that's called, in a lot of my live trading, a 3 strikes and you're out rule, which basically says if I have to adjust down, I have to adjust up, and I have to adjust down again, I'm out of the trade. I'm done. Had I done that, I would have come out with about a $2,000 profit in the M3 trade. And I think I talked about this a couple of weeks ago, saying I would exit this trade right now. This being a demonstration trade, we just hang with it. And we adjusted down, we adjusted up, we adjusted down, we adjusted up, I think almost 5 times with this particular position. So yeah, it is very, very unusual to move an M3 around that much, so much more than usual. That's right. All right, so that is that. The October V trade actually got no adjustments whatsoever. If you remember, we were just simply waiting to expire. So we did that. We came in here, we expired the October V trade. If we look at our analyze graph, we expired it for this amount here, whatever's on the graph, which is $704. And that was it with that. Small profit, but we'll take it. The market chopped around a lot. It was a very easy trade. There was really no adjustments right till the very end where we just kind of pulled the V out. But the problem is the market just settled right back in the middle of the V, which does tend to happen in volatile markets. A lot of times what happens in a really volatile market, particularly with these income trades, if you're being responsible with your loss numbers, is you're adjusting them up and adjusting them down, only to find out that the market ends up where it started, and you could have made a ton of money if you did nothing. That's pretty much not that unusual. And you see that more reflective trading the V Condor. You'll notice the same thing's happening in November. We have a lot of up move, a lot of down move. We end up right in the middle. The challenge is if you were in a regular Condor, would you have been able to withstand that move without adjusting anyway? Maybe, maybe not. Depends on your strategy, right? If your strategy is wide enough to withstand that move without adjusting, you did very well. If it wasn't, you probably got hammered back and forth and probably didn't do very well. So it's just a difference in strategies. But if I was reading the market properly, realistically, when the market went down and that straddle gained a lot of value, you could have pulled it and then traded and actually had a bonus in your Condor rather than a liability. But again, that's calling the market. That's not something we're doing with this update. So we're just following the rules. And that's how we ended up there. So I'm going to open the spreadsheet. I'll show you how our October went. If I drag this up, we have bearish butterfly for October. Fantastic trade this month, 30.1%. Very, very nice. We have our M3 trade, which is right here, which was a tough trade, but ended up being 3.4%. So decent gain there, not terrible. We had the rock trade, which ended up being 11.1 after close, which was good, and then we had the V trade, which was positive, but just barely. So putting those together for the year on the bearish butterfly, we are at 126.1 with 8 wins and 2 losses. For the M3 trade, we're at 52.1 with 9 wins and 1 loss. For the rock trade, we have 9 wins and 1 loss at 109.2. And for the V trade, we have 8 wins and 2 losses for 33.2. All trades are doing, the M3 trade is right on track for what I would expect. The bearish butterfly is a little more than I'd expect, but we're actually in a fairly good environment for that particular trade, so not a surprise there. The rock trade is, I believe, slightly more than expected as well. Rock trade 120 expected. We're pretty much in line with that. If we can get another 10% without any losses for the next 2 months, then we'll hit that number. So everything is in line. The V condor is not doing as well as expected, primarily because of the volatility in the last 2 months. So that is what we have. So let me close this out. Let's just quickly go over what we got going on November. I don't believe November had any adjustments with anything. So, right, so bearish butterfly in November, no adjustments. So we'll just go to Friday. So here we are, bearish butterfly in November. We are 3/3 entered. Because we entered this when the market was way down here, I think at around 1080. We're 3/3 entered. We're actually still up a little bit money. And that's what I'm saying. When you pay such a cheap amount of money for, actually the market would have been around 1120 when we entered this. When you pay a small amount of money, you can withstand a very large up move without drawing down really. With a bearish butterfly, so that's good. Now, if the market continues to go up quickly, we may have a problem. We may end up losing this trade. But if the market swings back, this is just going to be fantastic. If it goes up slowly, we should be able to manage that. That should be fine. But here's the position we're in. We have another roll point at 1170. We have, if we stay here much longer, we're going to start running into delta problems, and we're going to roll anyway. But as of right now, this is really, really nice looking. If we get, well, assuming the market doesn't go up too much and it pulls back, we could very easily hit profit target in this, even this week. So we'll see how that goes. On the, and that's where we sit. On the November M3, this also had no adjustments. And we are sitting in a position that looks like this. It's up about $2,500, right? We are getting close to having a delta issue here and starting to maybe put some verticals or pull butterflies off, but as of right now there's no issues there. And the November V condor thus far is suffering from the same thing that the October V condor was, although not as bad, and that is just kind of sitting here in the center of the position and not really getting any market movement. Again, we may end up having a delta issue and widening this out. But unless the market actually decides to travel somewhere, this is probably going to be another lackluster month for this. It's very unlikely you would lose, but very lackluster as far as returns go. So that is basically where all the trades sit. I actually do have one more question here. Okay, one's a comment. Okay, do I tend to use profit and loss from TOS or option view when estimating actual profit and loss in M3? Well, I use my broker. I don't, because my broker is where I'm actually making the trades, and they're going to have, as far as I'm concerned, the most accurate numbers. I mean, if I'm trying to decide whether you get out of it or not, realistically, you have to estimate what you're going to be able to fill stuff at, and you have to go in and you have to price everything and see what you're going to be able to get out at. Because your mid-price isn't necessarily, since like I say, since I say mid-pricing is not necessarily representative of what the position is worth, and your broker and option view are determining stuff off of mid-prices, then it's not necessarily what you have in the trade, right? So, that being the case, I have to go in, being a more advanced trader. I mean, if you're a beginner, then that's what you use, but being a more advanced trader, I go in and I determine what I think I'm actually going to fill at, and that's going to give me an idea of how much profit and loss I have in. And again, sometimes I'll fill much better than mid prices, and I'll be able to go in there and look at it and say, you know what, I can do a lot better than these prices, and I'll get out. And sometimes I'll go in and look at it and say, I can't, there's just no way I'm going to get these prices, and I'll just wait it out. So that is that. Here is A comment, nice job, 126% for the bearish butterfly as well as the other returns. Yes, thanks, Vincent. The returns on, yeah, the bearish butterfly, the rock trade has been fantastic this year. Actually, the M3 is doing very well too. It's just that it's not a high yielding trade, but for what it's expected of it, it's doing very, very well. I mentioned Trading Lab is that a Locke communities. That's going to be just in the Locke community. So. So if you're a community member, right, you don't necessarily need to be a coaching member for that specific thing. We will actually probably be doing, or I'm sure we will at some point be doing special webinars as well for the coaching people, which are going to be a little bit more advanced or more specific. But the Options Lab is going to be everybody in the community coaching, in the community, everybody who's a member of the community can go to. And I'm using, I use Thinkorswim and LiveVol right now. I've used Interactive Brokers, but I mean, I like the Thinkorswim platform, but they're expensive, but sometimes it's worth it so you don't make mistakes. So I do trade a lot in Thinkorswim. So, okay, so that's it. And I have one, just a quick basic question is, when I say a butterfly ratio of 1-to-1 on an M3, with a planned capital of 5,000, how am I defining, or just say, if I'm saying a 1-to-1 ratio with a planned capital of 50,000, I am defining that as 10 butterflies to 1 call. If I'm doing it in a $5,000 capacity, then I would be defining it as 1 butterfly to 1 IWM call. So that would be a 1-to-1 ratio in the courses. Is the spread as the short strike equal to 2 lots and the wing equal to 1 lot? Okay, that's just the same question. He's just asking me. He's just asking me that. So again, 1-to-1 ratio in the program. If I say a 1-to-1 ratio, I mean 10 Russell butterflies to 1 Russell call, or 1 Russell butterfly to 1 IWM call. And if an M3 is susceptible to a hard fast up move, why not throw in a call hedge? Well, then you're doing a regular M3, right? So if you do an M3U, the purpose of the M3U is to not go into IWM if you're in a small position, or if you're in a big Russell position, to have it unhedged or without a call. That's what an M3U is. So I wouldn't throw on a call hedge on that. If I was doing that, I'd be doing a regular M3. Is there an ideal planned capital number for an M3 trade? Well, yeah, I mean, here's the thing with trading, right? The smaller you trade, the harder it is to adjust something. And the larger you are, the easier you are to adjust something. So if you do, the reason I do $50,000 planned capital in the program is because you have that adjustability that you need. You can do, doing 1 vertical, if I'm in 1 butterfly, it makes a huge delta change that you really shouldn't be doing in the trade. If I demonstrate them with a $50,000 position, I can do that, right? And that makes it easier. And then, of course, the larger you trade, the easier it gets to make these more incremental adjustments. But 50,000 is a nice flexible number, and that's why we use it. You can do it with $5,000. It's just that you need to do it differently. And that's going to be confusing for a new person, which again is ironic. It's ironic that you have to, in order to trade smaller and get the adjustability you need, you need to be a more advanced trader, right? But once you're a more advanced trader, you don't have any problem incrementally adjusting a $5,000 position, right? So that's one of the catch-22s of coming into trading. But we demonstrate them with 50,000 so they're understandable, and then we show you how to do it later more incrementally. But you can do your back testing with the 50,000 position, and then you can do trade smaller utilizing IWM or pushing into the M3U. So that's what I have. So okay, and then there's this question about my estimate on pricing stuff and what the value of my position is. Basically, this is something that you are going to gain through experience. There's nothing that I can tell somebody who hasn't live executed and looked at certain things how to do it. It's something that you do. In other words, you can read a book about riding a bicycle until you're blue in the face, but until you get out there and actually do it and learn how to balance and drive it, you're never going to get it, right? You're not going to be able to jump on that bicycle and ride it from just reading a book or watching a video on how to do it. And it's the same thing here. You need to come in and basically watch what's going on, watch the pricing. Yes, you want to watch your synthetics pricing, but you also need to watch your pricing over time. And it also gets into just in general knowing that in this specific situation, options are going to fill well. In this specific trade situation, options are not going to fill well. So it's a combination of all that. So again, knowing generally how easy options fill and move around on a particular day or situation, watching the pricing over a period of time and watching all the synthetics within the pricing, and just generally knowing what things are generally worth. And that's the benefit of just trading one thing all the time. I know what stuff in Russell is worth. I know when it's overpriced. I know when it's underpriced, depending on various factors. So that is kind of how we do that. I mentioned in an M3 trade that, yeah, 3 strikes and you're out either direction. A lot of times I'll do that. I mean, I don't consider an up adjustment an adjustment per se, because more or less I plan on an M3 trade, I plan on entering the trade and adjusting to the upside. I don't consider that, that's normal, right? But if I have to adjust to the upside and then push it back, or push it, and or if I have to push it, or if I push it back once and adjust to the upside, again, that's normal. But if I push it back once, adjust to the upside, and then push it back again, that's telling me the market's being a little volatile for what I'm doing, right? So I generally don't like to stay in that market. I take my ball and go home. Again, that would be, it would have to be down, up, down, and then up again. But anyway, once I determine that the market's just being too choppy for the type of trade I'm in or how close I am to expiration, I tend to leave, because I don't want to take risk with a lot of money in an environment that's not, in other words, my trade's not suitable to the environment, so I move it. In my retail trading account, what strategies do I trade? I always trade an M3 trade. I always have M3 trades on. My retirement accounts, I always have bull trades and bear trades on. Well, I always have a bull or a bear, or a bull versus bear type of a trade going on in the trade, because they're really easy to manage and they're profitable, and I don't have to think about it, because if I have like 12 accounts I have to deal with and do something complicated in all of them, it's just too much of a pain in the neck. So especially with my coaching and training and all this other stuff. So so I'm usually dealing with bull trades, bear trades, in that, something I don't really have to watch a whole lot. And I always do a bearish butterflies opportunistically. In environments like this, I'm trading bearish butterflies in general. And then as far as a rock trade, I do an M21 trade, which is going to incorporate an M3 trade, a rock trade, a bearish butterfly trade, whatever it happens to be. So I am in rock position a lot when the environment calls for that, but I don't necessarily put on a rock trade every single month by guidelines, because like I said, I do take market conditions into account with a lot of stuff. Not with my M3 trades so much, a little bit with my bull versus bear trades. In other words, I might be off guidelines. I might be putting on a bull trade because I think the market's down a lot, or I might be putting on a bear trade because I think the market's up a lot. And that makes them very easy and simplistic to manage. Bearish butterflies are very easy and simplistic to manage when the market's been up a lot. Rock trades are a little more active. So when I'm really going for a lot of money and I see go to market opportunity, I will be in a rock trade. And yeah, do I have 3 strikes and I'm out on a bearish butterfly? I do when it comes into expiration, right? So when I come into expiration guidelines, in other words, usually if I'm trading a bearish, well, actually I actually have to get to my next webinar. But yeah, maybe we'll have a webinar on that, how to manage bearish butterflies. But usually you're not going to have that problem with the bearish butterfly. It's very unusual. And unless you get up into expiration, in which case, yes, I will. If it gets too choppy in expiration, I will exit. All right, everybody. Well, thank you for joining me, and we will see you next week.